Hello and welcome. This is Abhinav in a series of videos that I'm making on the various considerations on moving Indian business abroad, right? For ease of doing business or for tax savings, whichever be the reason. In this particular section, in this particular video, I'm covering the tax considerations that you need to keep in mind when you move your Indian business abroad, right? There are various tax compliances and considerations that are applicable. It's not simply incorporating a company in a foreign jurisdiction and then thinking that and continuing the business from India. All that just by doing that you will not save tax. If you have are under a myth, it is not like that, and this I will clarify in this video. So the first important thing is that you need to keep in mind section 9 of the Income Tax Act, right? This is a very very important section which says that income deemed to accrue or arise in India, right? If there is any CA professional listening to me, they are very well aware of what this section is about. This section basically says that basically Indian government taxes any income received in India, any income that arises in India, and then there is a certain set of income which Indian government says, in Indian Income Tax Act says that they will be deemed to accrue and arise in India. Right now, in that particular section, there are certain things which are like they're deemed as business connection. Right. Then there are some regulations with respect to place of effective management. Right. So if your business, with respect to its activities in India, fall into Section 9, incomes deemed to accrue and arise in India, and a business connection is proved as per the wordings of that section, then the income from that, the foreign income that you've earned, maybe in some other country your business is there, and whatever the income, that income to the extent of that Indian operations will be taxable in India, even though you have tried to structure the income, the whole transaction in such a way that the you escape Indian income tax. It will not happen, right? So one is that you need to consider the implications under section 9 of the Income Tax Act. Second, now you decide that you are incorporating business in a country where there is a DTAA, double taxation avoidance agreement, between India and that particular country. Right now, those then you what you need to see is that you need to see the relevant DTAA provisions, double taxation avoidance agreement, the provisions with respect to the permanent establishment, with respect to business profits, with respect to associated enterprises, and then there with respect to the individual payments like royalty, FTS, those particular the articles you need to study, and you need to study along with a multilateral instrument. Now what happens is, now there were existing DTAs that India had with several countries. Now globally, there, because of the base erosion and profit shifting that was being done by companies, there was a BEPS action plan that was laid out, and then there was a MLI that was executed, an MLI agreement. So every country has by default kind of signs up the MLI with respect to that country and India, depending upon various conditions and reservations. So you need to see the DTA, for example, India UAE DTA. You see, you need to also see the MLI provisions. What MLI provisions can get triggered, right? Now all these considerations are what I am saying is important when you are moving Indian business abroad, whereby some of the activities of the business continue to be in India. Right, so either you move your business completely abroad, right, nothing is in India, no activities in India, then you are safe. But if activities are done from India, then you need to see all these conditions. Your activity in India should not fall into section 9 business connection, or your business in India should not qualify as a place of effective management. You need to read the DTA provisions. There should not be a P in India. You need to read the MLI, that the principal purpose test should not get triggered. Right, all that things you need to keep in mind. PE exposure management. Now the general rule is that income of a foreign company with respect to its Indian activities are not taxable if there is no PE. So basically, the general rule is no PE, no tax. Right. So generally, if you have an Indian, if you have incorporated in like UAE free zone, and you continue to do Indian activities from India, you need to see and ensure that as per the India UAE DTA, that particular Indian whatever operation that you're doing should not fall in the definition of PE, permanent establishment. Because if it falls in permanent establishment, definition, then basically the foreign enterprise is treated as a resident of India, and then there are consequences, tax consequences to that, right? So you need to ensure that the PE risk is managed. Whatever Indian activities you do, right? It's like just incorporating a company outside India and continuing all the solicitation work from India. It will it will basically make no difference, because then it is deemed that there's a business connection from India, and whatever the UAE companies profits are there, even though they are tax exempt in UAE, it will be taxable in India, right? So you need to keep that PE risk in mind. I will make a separate video on how to manage the PE risk. So check that video and ensure that your nothing in your operations qualifies your Indian operations as a PE, right? Okay. Then there are GAR provisions. GAR, then there are SAR provisions also. GAR is General Anti-Avoidance Rules. So basically, it says Indian tax authorities are also smart. They don't want to lose. No source country will want to lose the revenue, right? So they are saying, if you are structuring a transaction which where the only purpose is to kind of tax saving, right? Which only from a tax perspective you are doing. Other than that, there is no other benefit. Then it will be treated as impermissible avoidance arrangement, and they activate the GAR provisions. Now, GAR provisions, when they activate, they will disregard whatever the DTA benefits and everything, and everything is taxable under the Indian Income Tax Act. So basically, when you structure your businesses outside India and within India, you always ensure that you take the benefit of the DTA, right? You get a TRC, tax residency certificate, from that UAE company. You ensure that the benefits under the DTA is there. There is no PE that gets qualified. But if the transaction falls into GAR, then as per the provisions, even the DTA is also overridden. So if you see section 90 of the Income Tax Act, it clearly has a provision, that 90 subsection 2 or 3, which basically says that the GAR provisions, the DTA benefits the person can assessee can take, but if it is falling, the transaction falls into GAR, right? Then the DTA benefits will not be able. So GAR provisions override the DTA benefits. So you need to be very careful how you, when you structure the transaction, it should not be only with the respect to the tax avoidance. Then there are transfer pricing compliances. So you have a company in India, you create another company in UAE, both our companies are owned by the same people. Then between the transactions, whatever happened, so there is a services. So Indian company is basically only a captive company which does the work with respect to the guidelines issued by the UAE company, right? Now, because these two are associated enterprises, between them, if there are any transactions, like there is a export of services by the Indian company to the UAE company, then that payment for that export services has to be at arm's length price. Both companies are treated as the associated enterprises. The transaction is treated as an international transaction, and whatever is the payment that is done has to be done at arm's length price. If you don't make the payment at arm's length price, then the Indian tax authorities will, so you should have paid like 100 rupees, whereas you have paid only 50 rupees, right? So Indian tax authorities will say, no, only because of both the enterprises being related enterprises, you have paid less, so we will consider the payment as 100. So accordingly, the tax liability of the Indian company will be increased in the assessment stage, right? Because they say that the arm's length price is 100. So if you are paying whatever 50 rupees, 60 rupees, 70 rupees, you have to ensure that the pricing is as per the arm's length price, as per the TP guidelines. There's a whole kind of regulation around the how to calculate arm's length price, what are the documentation that you need to maintain, and getting a uh, audit report from a CA, right? All those things are involved. So you need to pay attention on the transfer pricing aspects. Now, understand one thing, that there is a transfer pricing requirement in India, and there may be a transfer pricing requirement in that foreign jurisdiction, right? Even in free zone, even to the best of what my knowledge is, even in free zone, even though it's a tax exempt zone, even there, if there are transactions between kind of international transactions, there are some requirements on transfer pricing. So just understand, whichever jurisdiction you are choosing, Singapore or UAE or US, you need to ensure that whichever that country's transfer pricing requirements also you need to see. Good thing is that various countries transfer pricing laws are mostly kind of aligned, right? The India also complies mostly with the global kind of regulation around transfer pricing. So whatever study or you need to do, there will be like the that study will be beneficial for compliance under the, say, the UAE law, and as well as compliance under the India law. But there will be cost, there will be certain the compliances are associated costs that you need to make on a ongoing basis. It's not like a one time you do the study and everything and it's done. No, every year you need to ensure, you need to keep track and maintain documentation, etc. Then, with respect to, now, even if you move your business abroad, now think about a case where there are two partners. One partner is non-resident, another partner is a resident. So there is an Indian company where both the non-resident and resident partners are there, and directors are there, and then there's a UA company. Now for that resident director, there will be, in his particular tax return, he will have to disclose the interest in that UA company or whichever jurisdiction, and also offer the income, like any dividend that is given by the UAE company. He has to also take into account that dividend in his Indian tax return and offer it to tax. So otherwise, if they don't do it, then there are penalties under the black money law. So that also need to be carefully considered with respect to any resident directors or partners, right? Okay, then when you move Indian business abroad, the again choice of jurisdiction, I've made a separate video. It should not be driven only by the withholding rates and the tax benefits. It should be a holistic exercise. And the most important thing is your business acquisitions, customer acquisition strategy, ease of doing business. Those things. Tax is definitely one thing in the whole agenda. Now, when you have finalized the jurisdiction, then you need to ensure the see what the DTA, what are the rates, withholding rates. Now here what happens is that the business is done by UAE entity, Indian entity is like a captive, right? Kind of providing services. So India as a source country, and every source country is quite aggressive in terms of getting its share of revenue, right? For example, there is an export of services done by the Indian company to the UAE company of like 100 rupees. So then whatever are the withholding rates that are applicable, depending upon the type of kind of income, it's a royalty, FTS, any other kind of payment, accordingly whatever is the type of income, those withholding, as per the withholding rate, those payments have to be done by the Indian company, and that can be claimed as a tax credit, right? Yes, you need to check the DTA if there are any lower tax rates, lower withholding rates that are applicable, and accordingly that benefit can be taken. Then there are some thin capitalization norms that are there, that whereby the interest deduction to the Indian company will be disallowed if there is a certain shareholding that crosses a certain limit. So that thin capitalization norms also need to be checked with respect to the interest reductions in the books of the Indian company. Then residential status under the Income Tax Act for individual owners, partners, directors, and associated tax implications. So now one thing is the Indian company will be taxed on the Indian thing, right? As per the Indian tax laws with respect to companies, whatever the tax rates are there. But with respect to the partners, so in case of LLP, there will be partners, or in case of basically a private company type of structure, there will be directors. So according to them, depending upon their residential status in India, then the relevant tax compliances, according to that, they have to ensure. One of the requirement that like that I mentioned is the disclosure of foreign income and assets. Now, foreign country, you need to choose carefully the tax structure. For example, like in US, a lot of people, especially freelancers, they choose single member LLC, though it is regarded as a disregarded entity in US, and the tax liability comes on the owner. There has been a recent judgment in General Motors case. The ITAT Delhi has given a favorable judgment saying that the US LLC will be treated as a resident under the India US GTA and can get all the benefits that a resident gets, right? So you need to choose which type of tax structure. There are various, and according to the country that you go in, you will have different structures. So a relevant professional in that country will be able to advise you on the pros and cons of each structure. See and ensure that that particular structure gets the benefits under the DTA, and what are the compliances you need to make, right? You need to choose the structure carefully with respect to a tax perspective. Then you need to check the foreign country tax provisions, exchange control provisions, and the conditions for availing exemptions. Like even in a free zone, UAE free zone case, you need to ensure 1, 2, 3, 4, 5 compliances under the UAE free zone regulations, right? And there are multiple free zones, so and every free zone has its own conditions to get the tax exemption. So you need to have a clear idea on what is the jurisdiction I'm selecting, what is the structure I'm selecting in that jurisdiction, what are the tax law, exchange control provisions, and other conditions in that jurisdiction, so that you can make a holistic assessment of what compliances are. See, you don't want to end up going in another country and end up being non-compliant. A lot of people, do this quick work, right? That they have very much limited time to do. You need to plan. You need to kind of like, you know if you have like a decision to move out of your business out of India, you need to start from like 6 months, 1 year back. Before that, understanding the jurisdictions, understanding the compliance requirements. It is just, if you are like the last minute guy, it's like just in the last minute you consult someone and you end up making mistakes, right? So you don't want to end up. So my major purpose in kind of making these videos is that to give you an overview, kind of a pointers, right? So to the little that I can, to the little that knowledge I have, so that maybe some pointer can help you not to get stuck or make a costly mistake, right? Because you don't want to end up making some FEMA contraventions while you do all these things just for the sake of tax savings. No, you have to think broadly and give it some time, right? Okay. Residual. Okay, one more point. Okay, this was the last point. So the what one more point and final point is, see, if you structure your business in such a way that you still will be continuing some activities, a good portion of your activities in India, first of all you need to try and ensure that you mitigate the PE risk. The Indian operations do not classify as a PE, right? That is one thing, very important thing you need to do. But there will still be some residual risk. You implement everything, you may take all the precautions, exercise all the controls, right? Still there will be some residual risk of tax litigation, because income tax department, because this whole PE thing is a highly litigative subject. And the Indian tax department, see, will try its best to qualify that particular operations of your Indian company as a PE, so that it can earn the tax revenue, right? So there will be always a residual risk of tax litigation with the Indian income tax department. Always, before you do this exercise, consult with an Indian CA who has expertise in international tax, and also a foreign, the whichever country you choose, that country's CPA who has expertise in international tax on these aspects, the above aspects that I've discussed, so that at an initial stage only you get a full clarity on the tax implications, and accordingly you structure the transactions. Because if you make if you take care of these aspects at an initial stage, some aspects you cannot then change later on, right? So at an initial stage only, get in principle kind of a clarity on these things, and then at a final level, procedural level, a lot of things can be done, and even some mistake can be corrected. But at a conceptual level, all these things should be thought of at the initial stage itself. So I hope this video was useful. If you have any comments, thoughts, do share in the comment section. Thank you so much for watching this video.